Hello, welcome to another edition of The Full Picture. This time we've got the CEO of Supergroup, Peter Mountford, who will be giving us a bit of an introduction and answering some questions of ours on the business and how it's done. Before I hand over to Peter, I must just highlight, this is obviously going to be very interesting to most people because the results have been truly very impressive in what has been a very, very tough environment in South Africa. Over to you, Peter.
Hi, Vaughan. Thank you very much for those kind comments. Yes, Supergroup describes itself as a mobility group. So we primarily invested in three core areas: supply chain, fleet lease, and dealerships. On the supply chain side, we're invested across the United Kingdom, Spain, Germany, and Southern Africa. And we're very focused on integrated end-to-end solutions, which mean we're involved with our clients literally from procurement to freight forwarding, clearing, primary transport, warehousing, secondary distribution, and debtors collection and the like. So it's an integrated end-to-end supply chain type solution that we focus on across those territories. Approximately 40% of our profitability and revenue is where we target the supply chain contribution to be. The second core area is the fleet lease operations, where we have SG Fleet in Australia, which operates across Australasia and the United Kingdom. And of course, we have Fleet Africa in South Africa, operating across South Africa and Kenya. These businesses are obviously integrated fleet solutions businesses. We're not a bank per se, so our focus is not the funding of that fleet. It's more about procuring vehicles, maintaining them, scheduling them, tracking, tracing them, providing the tax information necessary for the underlying utilizers of those fleets, and providing residual value guarantees on those operations. And then the third area where we invested in dealerships in both South Africa and the United Kingdom. Obviously, we're a massive utilization. We have a massive utilization factor on vehicles, so it does suit us to be invested in the dealership space, both in South Africa and the UK. And here we represent about 51 odd branches and represent most major brands in this country. And in the United Kingdom, we've got about 34 dealerships, primarily Ford, Hyundai, and Kia.
Brilliant. Thank you very much, Peter. Perhaps we can go into a little bit of the fleet solutions. I see earlier on, I thought it was 51% of EBIT. I think it's 48% of EBIT, but roughly half of your EBIT. As you very clearly highlighted, you don't actually fund the businesses. Fund the actual vehicles, if we can use trucks as an example, but do the full picture. Perhaps you can just give us a little bit of a background in our well-known Transnet challenges, which has seen a massive amount of trucks going onto our roads. Are you seeing that business coming into your business as to a very significant extent? And has that been sort of part of the reasons why the results have been so good?
Well, just a small element. In the fleet lease business, some of those vehicles are on our balance sheets, both in South Africa and Australia. However, the borrowing related thereto is directly to the customer through a ring-fence structure with no recourse to either SG Fleet or Supergroup. So it is a genuine funding structure. That structure is in place to optimize funding costs. With regard to the second half, on the Transnet's issues, primarily rail issues and border issues, are certainly not an advantage to us. The ideal and optimum deployment of our fleet is between mine and railhead. For us to be considering moving coal long distance, for example, coal or even other substrates we do, such as copper and chrome and nickel and things like that, is not ideal. The ideal utilization is literally from mine to railhead. And there isn't a week that doesn't go by at the moment that major mineral producers don't approach us and say, look, they've got significant shipping slots in Richards Bay. They just cannot get their product down with the disruption of the Richards Bay rail lines. And that's a tragedy for us, because really a lot of those substrates cannot afford to be traveling on road on a round trip of 1,053 kilometers from, say, a Middelburg or a Belfast type area. So we are very supportive of the rail network. Our fleet will be more than adequately utilized if it was optimally operating in the space that I referred to. So we're not a big benefactor of it, and it's disruptive to us as well to have huge numbers of vehicles stopped at border posts into Maputo and the like. The reason we are moving a lot of our commodities into Maputo is those distances are manageable. It's still possible for the underlying commodity prices to carry the distance traveled through to Maputo, but the border delays are significant and challenging. And the right place for these products is to be on rail.
Thanks very much for that, Peter. That's why we have these kind of interviews, because we tend to have a view of the world, and you give us the real view of the world. The second point, which is quite interesting, is the dealerships. I mean, we've got the South African consumer that is, we read all the time and we see ourselves as relatively challenged. I do, to use an example, of which is not one of yours, is the Suzuki dealerships are sort of popping up absolutely everywhere. Perhaps you can just give some background as to why your dealerships are doing so well. What are you doing differently? How are you getting it right?
Okay, our dealerships, as you rightly said, have done very well, considering that South Africa is certainly an environment where the consumer is under significant pressure. There's no doubt about that. You are also seeing the consumer delaying purchase decisions or even purchasing down. And of course, you highlight one of the brands that's doing really well now is Suzuki. So funny enough, we have aligned with Suzuki, and we launched 3 new Suzuki dealerships in the last financial year, and they're amongst our best performing dealerships already. The same applies. So we're wanting to grow with Suzuki, we want to grow with Chery, we want to grow with products like Komoda and others. So the affordable market is definitely a focus space. I'm not saying the more premium vehicles are by any means dead, but most certainly in a Southern African context, there is a buy down, and we are very focused in those affordable areas. Why are we doing well? I think we've got a very strong management team in our dealerships operation. I think we've got a culture of service excellence, and we've got a culture really of searching for our customer base beyond the traditional geographic space that we operate in. And that involves digital platforms, trading platforms, and all those sort of things as well. So I think really the big differentiator is a very strong management team, very focused, very cost orientated. So we look to optimize costs. We've generally run multi-brand sites. So we've managed to agree with most of the OEMs, original equipment manufacturers, to look at multiple brands on these sites. I think the days where single brands could afford to carry these huge dealership sites are probably gone in South Africa. So there's a much more pragmatic approach to it. And yeah, we run a lean ship in that space. The same applies in the United Kingdom. The disappointment there has been the supply issue. We've not been able, particularly in the Ford brand, to realize, fulfill most of the orders that we had. Last year, I think we only had less than a 70% fulfill rate. There's pent-up demand in the UK environment, and the big disappointment is we're still seeing elements of the semiconductor crisis in that space.
Oh, that's really interesting. I think when we read, we think the semiconductor issue is absolutely solved, but clearly not. Perhaps just while we're on that, maybe you could just give some comment, and this is from your front seat position, EVs in South Africa. Do you think they're going to become a material size? I mean, we see massive forecasts of EVs, although if I can just put it in context, I was just looking at the OPEC forecast for oil going out, and they see peak oil beyond 2045. So they pushed way away from the 2030. I know Europe has now pushed back on EVs. I think it's the UK banning EVs beyond 2030. I think it's 2035. Perhaps you could just give us some insight on how you see it.
I'm relieved to see some pragmatic thinking coming through in the UK and Germany as well. I think the EV is highly problematic, and even more problematic in third world type environments with large distances such as we face here. The reality is we have electrical supply constraints, and secondly, our distances are of such a magnitude that it's really not the ideal solution. I was chatting interestingly and anecdotally with an OEM of a major manufacturer who said, well, their position is they would hope people would have a battery car for the city and something else for the long distance. And I think that's also unrealistic in our type of country and our type of economy, and in many, many countries in the world. So personally, I think the combustible fuels engine is a long way from dead. We all know that diesel is one of the most efficient ways of moving vehicles. So we are very concerned where original equipment manufacturers are focusing solely on battery. We think that, you know, they will lose market shares in many, many countries in the world. And I think that pragmatism is creeping in again, and the realization is creeping in. So the hybrid, of course, is a much better solution, but that's very expensive. So again, that has its downside in economies such as ours and many others. So yeah, I'm very concerned about the EV, and we would be concerned where brands become totally electric only. They will lose significant market share and probably struggle to survive in countries like South Africa. And, you know, the other element that is very unknown, and we're starting to see it creep into the UK, is residual values on electric vehicles. I mean, now we're starting to get 1 or 2 electrical vehicles come back. The residual values are appalling, way lower than combustible fuel engines, for the obvious reason that people are concerned about battery life. And that is a real issue. So, yeah, I think there's a long road ahead. And let's be honest, too, pragmatically, you know, combustible fuels are used in the generation of electricity. So I hope it will all be a lot more practical into the next 10, 15 years.
I think you've just highlighted the essential issue that we face on our side of the fence is the hype curve. It comes in, you see it, you know, it's the same as us. You know, something new comes in, they think it's going to change the world. It will, just not quite as quickly as everyone thinks it does.
No, exactly. And I think sometimes some of this hype emanates from countries that perhaps are don't have some of the very significant issues that many of us face. And it's very easy to get over-focused and unrealistic on some of these curves.
Fantastic. But if we could just go a little bit to the numbers, you know, and I promise you we're not going to go into the details that you'll need your CFO, but just sort of some broad context. I see, you know, your margin, your operating margin dropped slightly. Maybe if you can just sort of talk around some of the challenges there and what you see as a normalized kind of number over the next couple of years that us financial analysts can get our head around.
Yes, sure. I mean, obviously, we've just had a good year. So we had revenue growth of over 30% and headline earnings per share growth at close to 25%. So those were good numbers for us. And the performance came through across all of the divisions. Primarily in supply chain, we had quite a strong recovery in our consumer businesses. And those businesses were the benefactors of some significant new clients, both in beverages and food, an area like that, as opposed to necessarily growth rates in the market. So it was more about market share gains for us, and that contributed strongly to a good supply chain performance. Fleet lease went very well in Australia. The shortage of vehicles is still very acute in Australia. I mean, there's a country that doesn't manufacture vehicles. So not only the semiconductor crisis, you then have a logistics lag as well. So there's pent-up demand in the cycle in Australian fleet lease businesses, and order books are at record levels, and a lot of vehicles are moving beyond optimum life at this stage. The same in dealerships, still a hangover of some of the semiconductor crisis, pent-up demand in the UK, but the UK is looking soft at the moment. Sales volumes have not been exciting. You know, I think the UK is very caught up with concern around the high interest rate cycle, albeit that commentators say we're probably 2 quarters from the end of that. Concern around the ongoing war, of course, in Eastern Europe. I suppose concern now about the developments in Israel. And so many of these things are driving quite a soft position in terms of motor vehicle demand at the moment, surprisingly so. South Africa as well, and consumer under pressure, but our dealerships are performing very well in that context. Where's more normalized margins? Somewhere around 6.5% is normalized, which is broadly marginally below where we are now, but that is about the normal level moving forward.
And if we had to ask you, Peter, rough guidance, and we don't need real broad numbers, the business done well the next couple of years, you say pent-up demand in Australia, so that will help out, a little bit of softness in the UK, maybe more market share growth in South Africa. So some good numbers, high single-digit revenues. Do you offer guidance, or is that one of those difficult ones?
It's a very difficult one. We haven't offered guidance. I think in the medium term, moving beyond this financial year, some of the synergies in Australia are going to help. So we start to see, approximately $18 million worth of synergies come through from the historic acquisition of LeasePlan. We've just had a very good year. We're certainly not going to sustain those great growth rates this year. And we've been surprised at the softness that there is in some of the consumer space and the dealership space in the UK as well. So yeah, we would aim for high single-digit growth in revenue and hopefully through to the bottom line as well.
Thanks very much, Peter. Probably just the last point, just to get the clear understanding. We often see on our side of the fence that certainly in the US, and in South Africa, when you hike rates, it takes 12 to 18 months to really bite. So would you support that by saying that the softness in the UK is of the last 6 months and accelerated as a result of the hikes of the past? Would you support that thinking?
Yes, I think I would. That's certainly the perception we have at the moment. We went into this financial year with quite significant order books, and there are still significant orders in the pipeline, but the demand has been softer than expected. And I think it's exactly that. That's probably a very good summary of it, Vaughan, is that the higher interest rates are biting for the consumer. I mean, that having been said, there have been a lot of positives. There have been a lot of wage movements in the UK, a lot of salary movements in the UK. People are saying they're 1 to 2 quarters away from the peak, etc. So it's not all doom and gloom, but the softness of demand is quite marked in the UK at the moment.
Fantastic. I think given the time and given your time, thank you very much for the time. It's got great insight. Look forward to seeing another fantastic set of results from Supergroup without putting you under pressure. I'm sure all your investors are putting you under pressure, as they do when you've had a good set of results. Thank you very much for your time. Is there anything that you'd like to end with?
No, thanks very much, Vaughan. Just thank you for your time and interest. And we'll certainly do our best to deliver. As you know, it's a tough landscape, but we've just got to keep working at it and optimizing our cost structures and hopefully delivering on some market share gains. So thank you very much for your interest today.
Thanks very much, Peter. Thanks for joining us in the full picture.